We initiate coverage on MTS systems with a $43.77 price target and a sell recommendation. There are four main elements that underline our sell recommendation. First, high management turnover stands to undermine company stability. Second, current circumstances point toward difficult top and bottom line growth. Third, the company's future potential is clouded by an array of risk factors. And finally, despite positive, near-term financial improvements, MTS Systems still fails to value a market. MTS operates in two main product segments and one service segment: test products, sensor products, and test service, making up 68, 18, and 14% of revenue, respectively. Test produces durability and stress testing products with a 16% market share. Test relies heavily on a sales and development process that can take up to a concerning 2 years. The service segment is a recent and growing effort to respond to the demand of current test segment customers and holds an 8% market share. The sensor segment has a 6% market share. This more profitable sensors portion of revenue has been shrinking. The board and executive management have high turnover and low average tenure of only 3.7 years. An appalling track record for the current CEO at his previous companies leaves us very concerned, as can be seen by the 96% drop in shareholder value during his tenure at C&D Technologies. Executive compensation consists of long-term equity awards, a short-term goal-based bonus, and a competitor-derived base salary. Long-term incentives have failed to make up a majority of average executive compensation. Additionally, management has hit only 2 out of the past 16 short-term incentive goals. And what's more is that almost half of executive compensation has no link to company performance whatsoever. Now, the highly fragmented test industry is characterized by high switching costs and sophisticated customers, while the more transparent sensors industry has lower switching costs, welcoming higher customer bargaining power and a more intense competitive rivalry. I'll now let Matthew Wagner speak on competitors and current conditions.
Thank you, Mike. We chose competitors based on who MTS Systems determines to be their competitors and what products they offer. While MTS Systems revenues have been shrinking over the past 2 years, most competitors have grown revenues at more than a 3% CAGR. As can be observed by the debt-to-asset ratios within the peer group, MTS Systems remains relatively unleveraged, with only $21 million in borrowings in 2015. The omission of serious leverage neglects the benefits of cheap money in a low interest rate environment, echoed by management's tight-fisted approach to acquisitions, which have totaled only $65 million over the past 10 years. MTS Systems is investing in productivity and efficiency, seen by a CAGR average increase of 16% in CapEx. They are finally implementing a lean initiative to increase operational efficiency. Unfortunately, these efforts fall in the shadow of an unfavorable product mix and a weakening global environment. The test segment sells custom and standard products. Custom orders have much longer lead times and lower margins than standard orders. Due to an increase in custom orders, margins have been deteriorating, revenue has been stagnant, and pipeline conversion efficiency has been falling. Operating margins have been decreasing at a 3.7% CAGR since 2012. Custom orders now make up 72% of the order mix, which is much higher than the historical levels of 60%. The conversion percentage of available orders to revenue has fallen by a 2.8% CAGR over the last 6 years. Revenue has incurred currency losses totaling $50 million over the past 4 years, which may be misleading. In actuality, costs decreased in line with revenue, leaving the net effect at only $5.8 million. Going forward, with loosening monetary policies in Europe and Japan, we don't see the dollar weakening much. And this is troublesome because in 2015, tests made up 25% of test orders came from the US at 25%. 47% of sensor orders came from the European area, but demand for the industrial products that use sensors has been weak. MTS Systems is most dependent on Asia, with 54% of test orders coming from China alone. The region also carries the most uncertainty. China's GDP growth has fallen from 11% in 2010 to just 7% in 2015. Now I'll hand it over to Matthew Gapp, who will speak on valuation.
Thanks, Matt. For valuation, we chose to use the discounted cash flow to firm method. Even while built upon our optimistic assumptions of current initiative materialization and market growth, while being aligned with management's guidance, we still arrive at an unattractive per share intrinsic value of just $43.77. Our idealistic baseline scenario has orders going at 4%, which is faster than market growth, but is aligned with macroeconomic conditions and historical order growth. We expect the development time needed in additional hires to push the majority of benefits back into the middle of 2017. But after, we see revenues growing to $765 million at a 6.3% CAGR, and margins expanding to 43% by 2020. We optimistically forecast the high margin service segment portion of revenue to increase from 14% today to 18% in 2020. As a result, we predict that operating margin will increase likewise from 10.9% today to 14.5% in 2020. Terminal growth was calculated to be a robust 3.48%, derived from the OECD long-term forecast, while considering historical analysis of the industry plus the competitive advantages of MTS systems. Putting all of these optimistic assumptions together, we discounted our future cash flows using a WACC adjusted for increasing interest rates, arriving at a bleak intrinsic per share value of just $43.77. Analysis of the cyclical nature within the peer group, we arrive at an EV to EBITDA adjusted per share value of just $37.88, and an EV to revenue adjusted per share value of just $37.51. Both of these further supporting our DCF valuation. We performed a sensitivity analysis of intrinsic value by way of a Monte Carlo simulation based on historical fluctuations in key cash flow drivers, thus giving us an overview of all cases ranging from best case to worst case. We found that a whole 75% of observed events fell into a sell rating, giving us confidence that our assumptions are well-founded. I'll now hand it over to Katie Eckelman, who will touch on the risks facing MTS systems.
Thank you, Matthew. Risk factors for MTS systems vary from external, such as the macroeconomic risks mentioned earlier, to internal, some of which I will touch on now. We perceive product mix to be MTS systems' most evident risk. The global economy is shifting towards new technologies, which will only drive more custom orders. But management is not proactively pushing the product mix towards standard products, which may continue to squeeze margins and suffocate revenue growth. MTS Systems leverages their business on their brand image. Adverse effects on their brand may put stress on long-standing customer relationships and impair their ability to attract new customers. The successful implementation of HERT investments in productivity is paramount for MTS Systems' future success. Failure to successfully implement these initiatives will hinder their top-line growth and margin expansion. The industry is changing. The cheaper and more effective substitute for physical test systems, computer simulation, is becoming more and more relevant with advances in computational power. Supercomputing power has increased more than 60-fold in the past 10 years. Although MTS Systems believes that they are staying ahead of the curve, computer simulation still stands to incrementally eat away at their claims on steps within the testing process or administer a vital blow. I will now hand it back to Matthew Gapp to conclude.
In closing, management's high turnover, questionable compensation, the current adverse internal and external conditions, the evolving competitive landscape, and the looming risks place significant doubt on the company's long-term growth prospects. Despite expecting a near-term turnaround, MTS Systems' intrinsic value still remains a far cry from current market valuation. Therefore, we'd like to reiterate our valuation of $43.77, presenting a downside of 20.4%. We recommend a sell rating. Thank you. We will now take questions.
Thank you for your presentation. Just a financial modeling question. Looks like you've got margins, operating margins expanding in the next couple of years after the
So yes, we do have margins expanding, mostly due to these current initiatives, like you said, but there's many things that actually can affect these margins. I'll have Michael Wolf touch on product mix, but right now I'll touch on the current initiatives and investments in productivity. If their leader, they chose David Saylor to actually implement these Six Sigma Lean initiative. If he can't fulfill with these initiatives and push out these efficiencies, that does present a downside.
And one other issue with the margins would be if the custom order mix continues to increase as a percentage of total test orders, we would definitely see our forecast potentially not come to fruition.
And just following up on that, management has hoped that product mix would tick down from the current 72% product, but in Q1, actually, after we made this presentation, order mix actually increased to 77% for custom orders as part of the product mix, which is concerning.
So NDS receives a large percentage of revenues from ground vehicles, and since 2010 we've seen a significant increase in auto sales in the United States. Obviously, with your recommendation, you're negative on affirmative. If we do see sales plateau, what do you see some initiatives the company can pursue to help weather that type of environment?
So currently 55% of the test orders come from ground vehicle testing, and only 37% comes from the actual total revenue. Mainly, even though auto sales may be declining, automotive companies actually invest in R&D for future sales and not current sales. So we feel that it may be still a strong industry, and MPS believes that it's still a strong industry, but it happens that most of that industry is actually in China, which is slowing, as we all know. Current things that they can do is probably switch to push the service segment farther. Service segment actually has a lot higher margin than test. So I think we see that going forward as helping them possibly.
Thank you.
So after your study of the company and what you learned about its strategy, its position, its financial structure, you've alluded to, we learned a couple things that concern you. What would you tell management to do differently?
One thing that we see from management is that they currently believe that they are the pioneer in this hybrid technology for test simulation. As we've seen with their current customers, Jaguar has produced a vehicle, the Jaguar XE, that is 100% computer simulated with only one test simulation to validate their results. We think that this is something that MTS Systems can start looking more into in order to expand for current changes in customer demand.
And just touching on margins, this is a big part of them, is they have the squeezing margins in test. Management's been asked before, why don't you just increase your prices on your test products? And you can, this is a big part for you, and why don't you have pricing power there? And basically, they allude to the fact that they don't really have power with their customers being such a long sales cycle, and all the red tape that their customers have to go through to approve higher budgets for these capital expenditures. So we don't see that management going in that area to increasing pricing power there either.
You spent quite a bit of time talking about executive compensation and how you have an issue with it. Can you talk about what are the metrics that they're presently using that you have an issue with, and what, if you could design a compensation system, what would it be, and why?
Yeah, so for this we're going to be talking about two things primarily. That'll be the long-term equity awards, which I'll have Matt touch on, and then I'll touch on their short-term awards. So management currently has in place four different short-term incentive goals. With these, if management were to hit the max level, as shown by the top line there, their base salary would be doubled in solely short-term incentive bonuses. If management were to hit the middle line of target, then their cash bonus would be 150% of base revenue. Now we see this as being a problem for both management hitting these short-term incentive goals and the compensation committee maybe setting goals that are too high, disincentivizing management to work harder to hit these goals if they know that they won't be getting close.
And then as far as long-term incentives switched from a time-based vesting method to an ROIC-based vesting method. While we do see this as like a positive improvement, which will incentivize executives to hit long-term goals. We do see the ROIC that may sandbag further acquisitions in the company, as maybe they'll deter them from taking on leverage. We do feel that if we were to design a compensation policy, it would include some metric for long-term performance and short-term performance. We just feel that these goals maybe have to be better aligned with what management's capabilities are. And then
What metrics would those be?
What's that?
What metrics would you choose then?
Oh, so we would choose the same 4 metrics, but we just feel that these metrics should be better aligned with management's goals, and possibly include a metric that is focused solely on margins, such as turnover ratio or pipeline efficiency. I think that would be key to driving management's goals. Management is also aligned with, or is also compensated through perquisites. They have almost a $10,000 car allowance. We feel that this could just be adjusted out because we feel like maybe just it's disincentivizing to non-executive employees.
One last thing I want to add to that is that compared to MTS Systems competitors, MTS really looks at their base salary, whereas their competitors are more long-term incentivized. So that's somewhere else we would really want to expand, just to be a little bit more competitive with everyone in the industry.
If you could, I know you touched on the competitive position of MTS during your slides, but maybe just expand on it a little bit. In your view, what's the most important thing for the company in terms of its competitive position? And also, did you factor in the company's competitive position into your evaluation framework? And if so, how? Thank you.
So the most important factors for MTS Systems' competitive advantage, we believe, are their high-quality products, like their brand image. I think customers definitely look at MTS Systems testing products with kind of a premium quality in mind, and we hope that MTS Systems would continue to keep up that brand name by focusing on R&D. What was the second part of your question again? Sorry.
That's okay. I was curious if you factored that, your competitive position, into your evaluation framework. It looked like you guys did, but...
Yeah, we factored it into our terminal growth. Our terminal growth was 3.48%, which was the OECD long-term GDP forecast out to 2060. And then we added 150 basis points due to MTS's competitive advantages.
Thank you.
You guys are fairly blunt on the current management's track record, particularly with the CEO running this vast company to the ground. When you were out at the Analyst Day presentation, I'm wondering if you got a feel for whether the CEO and management have learned their lessons, so to speak, or whether they're still being overly optimistic in their outlooks.
So, as far from the investment day, management is going to portray their company in a positive way. I mean, strictly from management, from investment day, we weren't aware of these current histories of the CEOs. We looked more into it. We didn't draw anything from there, but looking back at it, maybe we can draw some things, but that's really speculative on whether they've improved or not. We just feel that as an investor, this company is very undercover, and this hasn't been brought to the public's attention. So just seeing that Jeff Graves' tenure during his company at Kemet decreased profitability of the company by 556%, and then at his tenure at C&E Technologies, the share price dropped by 96% and was finally taken private after being almost kicked off the NYSE during his tenure there. So both of these together are very concerning for us. And also, I'll have Matt Wagner or Katie come in here to touch on the leader of their biggest segment test.
So Jeff Graves and Bill Bachrach, the leader of TEST, do have an extensive history together. They, as you can see here, have worked for the same two companies in the past. They actually did attend college together. So we see that this kind of disappointing just because...
Thank you.